So I'm Max Elliskew. I'm the founder of Viewpost. I've spent the last 20 years in invoice payments and credit, originally at Bank of America, then as the founder of Elliskew Funding Group, which is the third largest invoice finance company in the US, and then into Viewpost.
And I'm Adam Hoffman. I'm from Capital One Treasury Management, where I manage the receivables business, as well as something called industry specialization. So Max and I are here to talk to you about one specific thing, and that's the friction associated with business-to-business transactions. What causes that friction? What are the costs associated with that friction? What's the solution? How do we fix the problem? And how do we benefit? And by benefit, we're talking about vendors that are doing B2B transactions, their customers, and even banks that participate in that flow.
But before we talk about the solution to the problem, we should probably talk about the problem. Help everyone in the room experience what really goes on in the B2B space. So what we see overwhelmingly is that big companies and small continue to produce invoices in their accounting system, whether it's Oracle, SAP, if they're large organizations, Microsoft Dynamics, QuickBooks, and overwhelmingly in the world, nothing at all. And they print them or they email them as pictures to their customers. I think the people in this room probably understand that when those emails come in and there's an invoice, they immediately hit print, they turn it back into a piece of paper, and it walks its way around the office along with the ones that were delivered in the mail, and people literally sign them. Eventually, they're taken to the accounting department, who oftentimes, using the exact same accounting system as their vendor, rekeys the information from the picture into the accounting system.
And if I've got a client, let's say it's a vendor, and the vendor wants to know, when am I going to get paid? Or even if I'm going to get paid. Well, the vendor doesn't have much recourse in communicating with their customer. So invariably, they'll either get on the phone, they'll fire off an email, maybe they'll put a letter in the snail mail. And as a result of that communication, they'll go back and forth just to find out whether or not they're going to get paid and when. It's incredibly inefficient.
And of course, we are here to talk about payments in this conference. And the reality is, overwhelmingly still in the US, we see paper-based payments that are being printed, stuffed in envelopes, stamps are put on them, they get put onto airplanes, flown and driven into other cities, ultimately taken to business owners who then take them to the bank, who sends them to the other bank to settle those transactions. So the problem with that, as ludicrous as it is driven by the fact that there is no registry. It's not easy to pay other businesses or people electronically.
And even if you're going to pay electronically, and it's a great point. So let's say you've got a customer, a vendor of mine, so a client of mine. And they say, okay, I'll pay electronically. They're probably going to get on the phone again. They're going to talk to my client and say, hey, I want to pay you by ACH, but can you give me your RTABA and account information? Maybe the vendor's okay with it, maybe they're not. Assume that they are. The vendor will give the information. You hope that the customer writes it down properly. They log into their online banking system, create an ACH template. Hopefully they key the information in properly, fire off a transaction. After the fact, they'll go into their accounting software. They'll register that they initiated a transaction. And oh, by the way, there's no remittance information getting passed as a part of the transaction. So maybe they'll shoot off an email saying, hey, you know that ACH that I sent you, it should clear today, maybe tomorrow. Well, this is what it was for. So once again, lots of inefficiency.
Right, of course, and we have third-party payment processors. They're the height of efficiency, and by definition, of course, they reinforce the nature of the problem. Their model is, I'll take the money from your account several days before you actually intend to make payment, put it into my account, insert myself into the credit and the AML risk associated with payment, and then I'll send an outbound payment to the vendor who will get payment from someone that they do not understand. Right? And of course, for you as the payer, you lose access to your funds, your bank loses access to the funds, my bank sits on all of the risk of me being a third-party processor just so that you can get payment from someone that you don't understand. Like, that's what goes on everywhere in the world as it relates to B2B commerce.
Now, there is a subset of customers that do get paid electronically. They tend to straddle more on the large corporate side. Those large corporate customers, they have leverage over their vendors. They'll say, all right, well, I'll do business with you, but only if you log into my procurement system and then send invoices that way. And so they'll get some electronic payments that way. But those same large corporate customers don't have influence over customers. And so in the end, everybody in this ecosystem is dealing with some form of a paper payment. So if you were to compare C2B flows against B2B flows, in the C2B space, I think you see 20 to 25% of transactions are still being sent by paper. You look at the B2B space, it incredibly lags C2B flows. You're talking about 55% of payments still being sent by paper, and the dollar flow is tremendous. It's like 25 trillion. I mean, this is a real problem.
And there's also an imbalance in who has access to cash. The reality is we see large corporates sitting on $2 trillion in cash earning nothing, with access to liquidity that they only consume 42%. For those bankers in the room, the easiest way to, of course, grow your balance sheet is get people who can borrow to borrow more. It's way easier than approving the people who today are small businesses and can't get funding, because that's what happens to the majority of them.
Mm. And speaking of funding, listen, I get it. I work for a bank, and we're in the business of making loans, yet you hear businesses struggling to get those loans. And it's not as if we like saying no, but there are real challenges here. If a bank is going to lend, and even though we're taking cash deposits for our clients and we have access to fairly inexpensive cost of capital, we need information. That information is predominantly around future cash flows. If we don't have access to those future cash flows, we're somewhat limited and restricted in the kind of loans that we can make.
Well, that's okay. I mean, it is easy to make fun of the banks. Right?
Thank you.
They do have free capital, and they certainly have customer trust, not necessarily always love, right? But certainly trust.
I'll admit that.
We read about fintech every day. We've raised $50 billion in the last 5 years to be able to democratize access to credit. And frankly, the truth of the matter is we don't actually democratize access to credit. Fintech companies have spent $50 billion making really good-looking applications that are easy to fill out. So in a small business marketplace where last year there were $455 billion worth of loans delivered, the fintech companies delivered 1%. We've raised $50 billion in 5 years. We deliver 1% of the loans. The reality is you deliver 99% of the loans, right? So you're safe for now.
Mm-hmm.
Right?
Thank you. So you add it all up, the cost of B2B transactions, the friction associated with it is incredibly expensive. There's two components. One is the direct expense. The direct expense would be the cost of processing and exchanging of paper invoices as well as the paper checks, $165 billion. But set that aside for a second. Generally, these flows are financed with relatively expensive credit vehicles, whether it's supply chain finance, factoring, or even merchant cash advances with APRs that could be as high as 60%. It's $3 trillion in dollar flows that are going through these fairly expensive channels.
Right. So why, when as consumers we've grown accustomed to sharing information seamlessly, easily, photographs, now payments, right, is that same ability to be able to share information not available in a B2B context, particularly given the size of the problem?
So with this problem, you see all these social networks that exist, job networks. Why isn't there a B2B network? Traditionally, whether you're a software company or a bank, you focused on a subset of the problem. You've either looked at large corporates, you focused on small business, maybe you've represented the interests of vendors, so you're looking at the AR side, maybe you've looked at the AP side, or you've even dug a level deeper and focused on a particular industry and try to create a solution. But the irony is my receivables are your payables and vice versa. So until you have a solution that covers the entire ecosystem, this friction is still going to exist.
Right. So friction, right, lack of efficiency, lack of visibility, right, cost, those are the symptoms of the disease. The actual disease is lack of connectivity across AR and AP, across big companies and small, across financial institutions. That's actually the problem that Viewpost and our partners like Capital One are focused on solving. Leveraging the precepts of social, where we've grown accustomed to being able to share information with anyone that we want without cost, that has value and is easy to use for the counterparty across AR, across AP, across financial institution, across accounting systems, right? So that businesses better understand their liquidity, better understand their working capital, have a better sense of their need, and so that their service providers, starting with banks, can predict and understand in advance of it being an issue, what's going to happen with their customers' working capital so that they can facilitate solving those problems in advance. So when then someone's going to have a cash flow deficit 5 days from now, it shouldn't be a surprise when that day arrives. and their financial institution can help solve that problem, transfer funds, extend additional credit in a seamless way that's delightful for users. And that's exactly what Capital One and our other bank partners are delivering across the Viewpost network.
Very good.
Yeah.
And we didn't get the buzzer. Look at that.
Oh, there we go.
Thank you.